Good afternoon, everyone. We're going to get started now. I still see a few other people getting on, but I don't want to hold this up for too long for those of you who are on. Today's topic is the 5 biggest mistakes and how to avoid them. And we're really focusing here on retirement and retirement planning. For those of you who are not familiar, and I think most of you on the call today either have been to a seminar or are current clients with us, Apella Capital is certainly first and foremost a financial planning firm. We believe that investments are only a part of the equation. I think that's very different from the way that much of the world of investment work, financial planning and investments work today. So really what we're trying to do is help clients set their priorities, determine their goals, but ultimately build a financial plan that really informs everything moving forward in their financial future. Certainly we're on the investment side, very dedicated to keeping our fees low, being transparent, making sure everybody understands everything that they pay. And certainly, more than anything, we're a fiduciary. Our clients always come first. And that's really important because still in today's universe, that isn't often the case. Apella Academy, some of you are on for your first Apella Academy webinar. These are a series of in-person or recorded videos, live webinars, and certainly plenty of written materials as well, designed to make our investment clients and our financial planning clients more informed about a variety of topics, right? We don't want to always just focus on things like investments. It's boring. It's not what people care about. We want to make sure that people have information to make decisions that are most impactful to their financial futures. And today really focuses on a bunch of things that we probably don't focus a lot of time on a day in and day out basis, right? And there are some really scary statistics out there, starting with the fact that I don't think most people today, especially millennials and even some of the boomers who are on the cusp of retirement, really were ever taught how much they should be saving for retirement, right? That 15% rule. I should be socking away 15% of my gross income on an annual basis because I need it to support the second half of my life in retirement. And if you really go beyond just that number, there's close to 62% of Americans who have less than $1,000 in savings today. There's 3 out of 10 Americans actually report having $0 in their savings account. And more so than that, 43% of Americans haven't spoken to anybody about retirement planning. 21% of Americans today are not confident at all that they'll be able to reach their financial goals. And twice that number of Americans 25 and older have established no financial goals at all. So how do we actually prepare for retirement if we're not even setting those goals or have any idea about how much we should be saving to make sure that we don't run out of money at some point in our future? So it really all starts with that, right? It starts with understanding what you spend in retirement. And still today, about 70% of Americans, and that's a big number, live spontaneously, right? They don't have any idea of what they spend or where the money goes. And I get it. Budgets are boring. Budgets are tedious. It's a word nobody really wants to think about because a budget implies that maybe I won't be able to spend money on the things that I want to do now. But budgets give us valuable information, and that information really can't be found anywhere else. It also provides us valuable information about your financial future. And what do I mean by that? Well, if you really think about it, retirement spending is tracked through a variety of studies, and one thing remains pretty consistent over time, and that's retirees spend less than people working today in almost every category, with the exception of things like healthcare. And it's evident across generations, meaning this isn't a recent trend because of maybe a 2008 market issue. This is the case over multiple generations. Expenditures, personal expenditures, simply decrease as we age. if you really think about what your financial future is going to be, when you get into retirement, we kind of break it up into thirds. You've got the go-go years, the early portion of your retirement years where you're more active, you're doing things, you're traveling more to more exotic locations. That transitions into the slow-go years where maybe you're still traveling, but you're not going as far. You're staying closer to family, as maybe you're having grandchildren. And then, inevitably it becomes the no-go years where we're really just aging in place, maybe having some type of minimal travel. But at the end of the day, most of our expenditures are going towards things like healthcare. So when we talk about how much you spend today, that gives us valuable insight into your future because we analyze what that's likely to look like on an individual basis, right? How do you spend? What are your trends? What are your plans for your financial future? Do you plan to travel more for a certain chunk of years? What are those travel plans? What is your thought about dining out? Are you more likely to cook at home or go out more? So there's a lot of these different things that impact what our financial future is going to look like. So if you really break down spending by age and category, it's pretty obvious. There's certain things that occupy a larger percentage of our budgets, right? Healthcare, housing costs, things like transportation and entertainment. But it's really important to start to think about, what are your spending patterns going to be or more likely to be in retirement, right? Is your mortgage going away? You'll likely spend less on things like clothing, right? Because you won't need as much work attire. It's more casual. But a lot of people are more likely to dine out more frequently, as I mentioned earlier. Now, all these categories you can see below have different inflation rates on them, meaning they increase at different rates over time. So thinking about how you spend on different categories and the impact of inflation on those, and we're going to talk a lot about inflation in a moment, is really important. So when we do this, we have technology that allows us to aggregate your income and your expenses from a variety of different sources and track that. And obviously, the number one thing that we want to do in any financial plan is really understand what your retirement goals are. And it all really starts with a budget. How are you spending now and how are you likely to spend in the future? So I mentioned that we're going to talk about inflation, and inflation is, it's really the silent killer, right? It's the decreasing of your purchasing power. So if you look back over time, I just happen to pick my go-to meal at just about any restaurant, the cheeseburger. You could have bought 6.5 cheeseburgers in 1940 with $1. And if you look at what that actually equals today, granted, that's more like a McDonald's hamburger, maybe one cheeseburger today versus 1940. But when you go out into the future, you're going to be lucky to even get a bite of a cheeseburger if you measure it in terms of inflation, right? It's the loss of purchasing power over time. And once again, that's one of those things that we don't often think about when we're doing our future financial planning. And if you look at inflation over time back to the 1920s, you certainly can see that there are a lot of different spikes up and down. And inflation recently has been historically low post-2008. There's been some ups and downs in there, but you can see it's remained relatively below 3% for quite a while. Last year, roughly 2.1% in 2017. And, by certain forecasts, it's expected to be about 2.6% this year. That 0.5% is a considerable increase in an inflation rate in a short amount of time. Now, that doesn't necessarily mean that things are going to continue to spike up above that, but certainly it's an indication that times are changing here, right? And when we get into extended periods, and the stock market's also like this as well, that when the stock market continues to go up year over year over year, or inflation remains low year over year over year, we get lulled into this false sense of security, right? It's this recency bias that we think it'll just continue into the future, and that's not always the case, right? If we're looking at basic examples of, in 1950, if you look at what inflation's been since then, something that cost $20 in 1950 would cost over $205 today. Something that cost $20 even as late as 1990 would cost almost double that at $38 today. Inflation is the erosion of your purchasing power over time. Goods and services that you will be consuming in retirement will be increasing. And we looked at it earlier, some at a very different inflation rate than another. So in the news recently, the president had mentioned possibly proposing tariffs on things like steel and aluminum. And that could exacerbate inflation even more. If we look at inflation at its most basic things and how it impacts us on a day-to-day basis, it's, how much is that new car going to cost in a few years? How much is travel going to cost in a few years? But we can see it even more recent than that in things like restaurant prices. Restaurant prices actually spiked pretty sharply over the past couple of years with the increases to minimum wage. Auto insurance is going up at higher than normal inflation rates as well, as cars become more and more reliant upon technology, and all these gadgets are a heck of a lot harder and more expensive to fix. So it's not just things like housing and healthcare and food. Inflation has a pretty dramatic impact on all the things that you'll consume over time. In the interest of time, I'm not going to spend really any time on college here, but it's really evident just looking at this chart if you're currently putting a child through school or have grandchildren in school or, are still paying off those college loans. This is a trend that has shown no real signs of slowing down as well. Along with healthcare, it remains one of those things that inflation compounds much faster on. So let's think about inflation and how to actually protect against it, right? So what we do here within every financial plan that we run for clients is we want to test against different inflation scenarios, right? What would happen if inflation remained low? What would happen if it spiked for a period of years? What would happen if it went up to 4%, 5%, 6% for an extended amount of time? Essentially looking at it that you have a finite amount of resources to carry you through your retirement. And if inflation spikes or goes higher and remains there, how is that going to impact your finite bucket of resources, right? Will you run out of money? When will you run out of money? So when you think about historically, what are good ways to hedge against inflation and the loss of purchasing power? You've got things like stocks. Stocks traditionally are the best hedge against inflation over a long period of time. And globally diversified stocks are even better, right? Not every economy is suffering from the same things, right? And that's the beauty of diversification. In fixed income, it becomes a little harder, right? And really, if you think about inflation at its core, right, as inflation is increasing, that's generally typically seen in an expanding economy, which also leads to higher interest rates. And we're seeing all of those things right now. And how do you defend against that in fixed income or your quote-unquote safer bucket of assets? Well, it's a little bit harder, but there are things like TIPS, Treasury Inflation Protected Securities, that can help minimize and eliminate the impact of inflation on your fixed income portfolio. Real estate investment trust, REITs, are another great hedge. And the great thing, really, when you start to kind of add all these things up, it's what a diversified portfolio should be, right? Globally diversified across multiple asset classes, things like fixed income and certainly REITs in there as well. And for those of you who are already clients of ours who are on this call today, rest assured that all these things are actually in your portfolio. Often overlooked are things like Social Security strategies as well. And we're going to talk a lot about those in a bit. But remember, Social Security is lifetime income that has an inflation adjustment built into it. So it's lifetime income with inflation, which is essentially protecting the ability for you to purchase goods and services in the future as well. So, when you really boil it all down, all of these are great hedges against inflation, but you have to choose the right portfolio and the right Social Security strategy, and putting that all together is really at the core of what we do here. Here's an interesting one. I think many people still today, surprisingly enough, underestimate what healthcare is going to cost them in retirement. In fact, I have a pretty good idea that folks who are, 10 years away from retirement, maybe even 5, don't have a clue of what healthcare costs in retirement. There's actually quite a few folks out there today who still believe that once you retire, healthcare doesn't cost anything. It's, provided by the government. And that couldn't be further from the truth. What you're looking at here on the screen is different age groups and the average monthly healthcare spending. This is, an average across the nation. There are certain factors where you live in the country, for example, that will impact these numbers dramatically. But how many of us have actually thought about what our expenditures are monthly on healthcare spending, right? And if we're looking at this from an individual standpoint, and I think, okay, well, I'm spending $500, and my spouse is spending $500, have we accounted for that extra $1,000 in our retirement budget for healthcare? It's often overlooked, probably equal to how people overlook inflation. So when we start to look at healthcare costs, there's a few studies done every year. Fidelity has one of the more popular ones. And essentially what it's saying is a 65-year-old couple retiring today in average health will need roughly $260,000 in today's dollars to cover all of their retirement healthcare expenditures. Now, the 2017 numbers haven't been updated yet, so I'm not sure what that increase is, but that was a $15,000 increase from the previous year. That doesn't include things like long-term care, right? That is just your normal premiums, deductibles, out-of-pocket expenses, and that's for a person in average health. So how are you health-wise? How's your spouse? What's your family history? These are things that we want to discuss with you, because targeting what you're most likely to spend on healthcare in retirement can have a dramatic impact on whether you survive retirement financially. I'm not going to spend a lot of time on this section here, but I think it's important for everybody to understand the different parts of Medicare, right? There's Part A and B, and those are what's considered to be traditional Medicare. In fact, they're provided by Medicare. Part A covers hospitalizations. Part B covers the cost of medical services like doctor's visits, procedures, diagnostic tests. Part C are also part of Medicare, but they're private insurance company provided by those insurance companies who contract with Medicare. So here's where it gets a little bit confusing, right? How much does all of this cost? How much am I going to be spending? What are the different parts? What's the right combination? And all of this is really challenging, right? So if we just start with the costs, Part A, there is no monthly premium on Part A, essentially just like Social Security. If you've worked for 40 years in a Social Security covered job, essentially 10 years, you have Part A coverage. There are deductibles that if you get sick and go to the hospital, it's about a little under $1,400 for each spell of illness. And if you're there for longer periods of time, 60 plus days, that co-insurance can get really expensive. It's about $335 per day. So those costs can add up quickly if you have a spell of a health issue that lasts for a considerable amount of time. When you're looking at Part B, right, the part of Medicare that covers your doctor's visits, those are roughly $134 a month in premiums and about $183 in deductibles. But the thing that often goes overlooked here is that it's $134 a month in 2018 if you essentially if you're married and have a modified adjusted gross income of $170,000 or less. So what does that mean? It means the more money that you earn in retirement, right? Things like Social Security, distributions from portfolios, deferred compensation or pension plans, it adds up. And there are income-related adjustments to help with the solvency of Medicare. So if you make over $170,000 and up to $214,000, that's an extra $53. So they add up quickly. I'm not going to go through all the numbers, but depending on what your income could be, your Medicare premiums just for Part B might actually be close to $400 a month, and that's per person. Those income-related adjustments also apply to Part D, right? Your prescription drug coverage, although they're not as large. On average, it's around $40 a month for prescription drug coverage nationally. And once again, those are provided by contracts with private insurance companies. So you actually have to seek that out. It's important to understand this because how do I control certain amount of income? Is there a way that I can align my portfolios or my distributions that push income off into the future, defer it, make my portfolio more tax efficient? Because when I start looking at $50 a month increases or $100 a month increases or as much as $300 a month increases, depending on my income in retirement, I want to be able to manage that costs. It goes up dramatically, as I said. And when we're actually doing a financial plan for folks, we have projections for what future income will be on things like required minimum distributions and Social Security. So we actually can predict with pretty good confidence what your healthcare costs are going to be in retirement. So we can actually put that into the plan and test the solvency of your own plan. So when you are looking at healthcare and you're thinking about how much it's going to cost you, it's important to look at the different components of Medicare. And the other thing that we do for folks is, we look at, well, what are your retirement goals? Are you likely to travel? Do you have two homes, one in Connecticut, one in Florida, for example, and spend time between each? Well, maybe a Medicare, traditional Medicare with a Medigap plan might make sense for you. Are you relatively healthy and live in one geographic region? Maybe a Medicare Advantage plan would look good for you. What types of drugs are you taking? How can we help to make sure that you pick the right plan that is the most affordable and fits into your actual lifestyle? Because that's a big part of retirement planning, is choosing the right plan for the right cost. And remember, that's one of those things that you're going to have to shop for every single year. When you have something like Part C or prescription drug coverage, these insurance companies change what's covered almost annually, right? So costs can go up, coverage can go up. It's important to review that every single year. So that doesn't actually, that leads into this next part of it, right? None of the costs that we just talked about have anything to do with long-term care insurance. Now, this is the thing that none of us want to experience, but I'm sure all of us have had some experience with through family or friends, people we know. And these are looking at what are the national costs for 2017 versus what that might look like in another decade. Once again, inflation being very different on healthcare costs than it is on a can of Campbell's soup, for example. So people are living longer than ever, but they may not be living that well, right? Health, better food, better diet, better exercise, it's preserving us for much longer. But as we age, we're also exposed to more risks of having these types of long-term care needs. So people are living longer than ever, and especially women, right? Women outlive men by about 5 years on average, and they're the ones most likely to need care in the future. Regardless if it's a man or woman, none of us really want to be a burden to our child or any member of our family. And we certainly don't want to have to spend down all of our assets just to qualify for Medicare, for Medicaid. I don't think any of us like the idea of spending down money and then ending up in a facility that while you're on Medicaid. It's a very depressing thought. So, obviously we believe that information is power, and it's really important to test every single client's financial plan against a long-term care health issue, right? And that's at different stages of their life. What would happen if you got sick at 70, 75, 80, or 85? What's the impact of that on your financial plan? Some folks can self-insure, right? They might have the financial assets to survive a 2 or 3 year spell in a long-term care facility. Others can't. Knowing if you can or can't, there is some peace of mind in that. For those who can't, obviously something has to be done about that, right? So essentially what we do for folks is we'll run quotes from multiple providers. Now remember, we're not an insurance company or insurance agency. We essentially shop the entire insurance marketplace to try to find the best solution. And there are quite a number of different solutions out there, as not only have healthcare costs changed, how you get long-term care coverage has changed quite a bit over the years. So when we start to think about what can we do to make sure that we're aware of all these different things from a healthcare expenditure standpoint, knowing when you're supposed to enroll in Medicare, that's really important, right? When you miss an enrollment period after you retire, or when you're 65, or if you have special circumstances, missing those might leave you with periods where you have no health care coverage at all. That could be catastrophic financially. If you, as I mentioned earlier, if you're already on Medicare, you should be fairly used to getting the supplements annually. They will flood your inbox and your mailbox around October of every single year. It's important to shop coverage every single year because, like I said, especially with Part C or Part D, your coverage can change dramatically, and certainly the price can change dramatically. So it's important to make sure that you're not spending too much for something that you could get elsewhere for a heck of a lot less. Long-term care, do you need it? I don't know. Some people do, some people don't. But it's better to know if you do or if you don't. So at the end of the day, it's worth a look. And there are a lot of different options out there. Normal long-term care insurance, it can be expensive. There are certain types of policies where you can pay less and hedge against at least a portion of the risk. There's life insurance with an optional healthcare rider on it. There's different things where you can pay into it for 5 or 10 years and have coverage. Essentially, what we want to do is analyze all the existing potential coverages for you. So if you have existing coverage or you have existing life insurance coverage currently, and you want us to review that to see if it still makes sense for you, if there's something better, we're happy to do that as well. But it's really important that certainly we know about your existing coverage as well. So as we continue, I've been doing this for quite a while now, and this is probably the area where I get the biggest pushback, right? People are always telling me I'm never going to live that long. Doesn't matter what age I say. Saying 75, say 80, I'm never going to live that long. Well, statistically, that's not the case. So longevity risk is the economic consequence of outliving a portfolio of financial assets that's been tasked with providing you lifetime income. And longevity risk is really dangerous because none of us know with any certainty how long we're going to live. So we do have to turn to the statistics in a way. So the way to think about this chart, right, and I'll draw your eye to age 90 in the middle of the page. If you're looking at that, as a woman, a single woman, individually, there's a 34% chance that if you are 65 today, you will live to age 90. Men, if you're 65 today, there's a 22% chance you will live to age 90. That woman and that man, if they are a married couple, statistically, there's a 49% chance that either the husband or the wife will live to age 90. 49% chance is essentially a coin flip. So when we talk about I'm never going to live that long, that's not what the statistics bear out. There are more and more people living to age 95 and 100 than ever before. With the changes in healthcare, the advancements in healthcare, better quality food, people being more into exercise, being more aware of their own bodies and how to take care of them today in this information age that we live in, it is very reasonable to think that everyone on this call has a pretty darn good chance of living to age 90 or 95, right? So if we have this finite bucket of resources, right, my financial portfolio, I need to make sure that it's going to survive a 30-year retirement or a 35-year retirement. There's a chance that there's going to be a lot of people retiring very soon who will spend more time in retirement than they did in their working years. So I could certainly put off retiring, right? I could work longer. I could save more money. I could spend less. I could adjust my goals. I could take more portfolio risk. There's a lot of different ways to think about how to protect against this unknown time horizon. But it's important that you know that as a single person or a part of a married couple, it's really important to think about your own longevity and not underestimate it. And we talked about this just a second ago, right? How do I protect against longevity risk? Well, I could stay in the workforce longer, right? And more people today are staying in the workforce longer, right? They're motivated by a lot of different reasons, but it is certainly a trend. If you look from 1996 to 2026, certainly the total amount of people age 65 and older has increased over time, right? There's a lot more boomers retiring today. I mean, not retiring today. There's just a lot more boomers. But there's a lot more of them in the workforce. So when you're looking statistically, about 37% between the ages of 65 and 69, 23% between 70 and 74. I see it with the people that I work with today. Retirement's changed. And it's not just because I'm worried about running out of money per se, or the market did this, or I'm not really sure if I've saved enough. People identify with work. They want to stay active. They want to stay involved in it. They like their jobs. They want to try something new. So the idea of retirement has certainly shifted, and that's a good thing for a lot of folks. What's your expected time horizon in work? Do you believe that you will continue to work past age 66 to age 70 to age 72? We work with a lot of folks who actually continue to work past age 70. So it is something to consider, and its impact on your financial plan is something to consider as well. I don't want to spend a lot of time on Social Security, but I think it's important to understand Social Security. PIA is your primary insurance amount, right? And what happens if you apply for Social Security benefits before your full retirement age? In this case, the example is 66, and the benefit amount is $2,400 a month. So if I'm going to take Social Security at age 66, you can see I'll get 100% of my primary insurance amount, $2,400 in this example. If I take that as early as age 62, which I'm entitled to do, I'm only going to get 75% of that benefit, or roughly $1,800. You'll see that it does increase incrementally between the ages of 62 and full retirement age at 66. But, once you take your benefit early, you can't do anything about it, right? I've essentially elected a smaller benefit amount, which means when cost of living adjustments are applied, they're being applied to a smaller benefit amount. So how do I get the most out of the system? Well, getting the most out of Social Security generally means not claiming early or prior to your full retirement age. Social Security is an incredibly big part of retirement planning because it is a lifetime and inflation-adjusted income source. Most of us don't have anything else like this in our retirement income bucket. So planning for this is really important. So claiming early can be very detrimental, especially for a couple, less detrimental for an individual. What happens if we're going to wait past full retirement age? We talked a lot about those folks who are claiming Social Security later because they are working past typical retirement ages like 66. So for every year that you delay Social Security beyond age 66 in this example, Social Security awards an 8% annual delayed credit all the way up to age 70. So, for example, at age 67, you would get 108% of your primary insurance amount. At age 68, you get 116%, all the way up to 132% of your benefit amount. So that $2,400 is now worth $3,168 of monthly retirement income, once again, for life with inflation adjustments on it. There's not a lot of other places, and I can't think of any, that I can go out there and get 8% with certainty. So this is an interesting place to look at. And for those who plan to work beyond full retirement age, they should consider delaying benefits. When you actually look at the two compared against each other, it's pretty dramatic, right? If I'm going to, and I'm looking at the far left side of the chart here, what is the impact? Between the ages of 62 and 70, the two extremes. If I claimed early, my benefit amount would be $1,800 at the start versus $3,168. If I take that out to age 85 in today's dollars, that's about $518,000 if I claimed at 62 versus $608,000 in total payments from Social Security if I'd waited till age 70. That doesn't seem to be that dramatic of a difference. But when you layer on cost of living adjustments, which historically have been about 2.7, 2.8%, and now you put that cost of living adjustment on it, now that 62 benefit is worth $3,397. It's pretty good. Versus the age 70 benefit of almost $6,000. And when you take that and you look at it cumulatively over a 20 plus year time horizon, that is a fairly significant difference in benefits, right? $726,000 from Social Security by claiming early versus $941,000 if you were to delay. I'm pretty sure that most people would like to have an extra $200,000 somewhere in their retirement plan. So what we do with Social Security is we look at a variety of strategies within a financial plan. What would happen if we delayed? What happened if we were to claim early? If you were to delay, obviously, and you're not working, you have to rely on your bucket of invested assets to support you during that time period. And we'll show you if that actually works for you. If it doesn't, what happens if we are drawing down during a delayed Social Security benefit and the market goes against us? So we've tested for all these different scenarios, and these are personalized strategies that we want to run for you. These are not rules of thumb. Unfortunately, I think when we get advice on things like Social Security or longevity, or really any financial topic, a lot of them become rules of thumb. And let's face it, each one of us is very different in terms of who we are, what our income, expenses, and our goals are. So these are not rule of thumb based. One of the other things I want to talk to you about today here is really investment risk. And this goes hand in hand with a lot of the things we were talking about. How much money did I save? How much money do I have invested? What do I think the market's going to do? How much do I need to take out of my portfolio every single year? These are challenging things to consider, right? Because the impact of inflation can be dangerous. The unknown of your own lifespan is daunting. Investing appropriately, meaning how much risk you should be taking, that's a tricky subject, right? It's a hard thing to navigate because we don't want to run out of money at any point in our retirement, but we don't want to be so conservative that we're forced to sit home and just stare at the wall all day. So how do we balance this? And really, it's our job or any financial planner's job to help you pick the right portfolio. And a lot of that starts with, what type of investment should we use? So, this is really just up here to show you that professional money managers, people who might be on CNBC or Bloomberg and talking to you about what's going to happen in the stock market moving forward. You hear them on TV and you believe that they have some type of expertise, right? They should. They went to the best schools. They've got research staffs. They come from big companies. They're very smart. They do well on television. But at the end of the day, these people cannot outperform an unmanaged benchmark, right? So if we're looking even at the first one, the S&P 500, right? That's large cap U.S. stocks. What we're showing here is that over a 10-year time horizon, 85% of mutual fund managers, right, the people that are on CNBC, underperformed an unmanaged benchmark. So you're paying these professional money managers, essentially, who claim they can beat the stock market, you're paying them a fee where statistically they have almost no chance of doing it over a long time horizon. And that's true against all these different asset classes. So when we start to think about how we should invest, it really starts with, well, what are my beliefs? If I know statistically over time that these so-called geniuses or experts in the world of investments can't actually beat the stock market, well, then why am I going to go into this competition against it? I want to participate in it. I want to invest with the stock market. But that doesn't really answer the question of, how much exposure you should have to stocks. That's a little bit more personal, and we'll get to that in a second. But, once you kind of take a step back and you say, all right, well, I'm not going to go and pick a bunch of individual stocks or pay somebody to do that for me if it doesn't work. Well, what should I do? And the answer is I want to own everything. Not equally, but I want to own everything. I want a broadly diversified portfolio that goes across all these different asset classes. And really what you're looking at here is from 2008 to 2017, right? The top left to right. You're looking at the best performing asset classes from top to bottom to the worst performing asset classes. So if we look at 2017, for example, the last column all the way on the right, the best performing asset class was emerging markets. Most people believe that it was the S&P 500, right? They believe it's domestic large cap stocks. Domestic large cap stocks have done very well, as indicated in the white block across the past 5 years. They've done quite well, but in none of those years have they been the top performing asset class, which is why we want to think about broad diversification. Right? If we're looking at 2017, we stay on that column. It's emerging markets, it's emerging small cap, it's international small, it's emerging value, it's U.S. growth, it's international. Right? These are the things that a typical investor doesn't have any or has too little exposure to. So we want broad diversification across all these different asset classes. And, we want to make sure that when we take a look at your financial plan, it's what's the right proportion of stocks to bonds. And once we know that, right, once we know that 50% stock or 60% stock is the right portfolio for you to get to your goals, then we want to broadly diversify it across all these in low-cost mutual funds or ETFs, right? That's part of the overall financial plan, is helping you pick with and stick to the investment decision that we've made together, and a financial plan certainly informs that. Oftentimes, we see that people's portfolios are simply a collection of different things with no rhyme or reason. You want to own a portfolio, and owning a portfolio means that at any point in time, there should be something in there that you wish you didn't own. That's the idea of diversification. If everything looks fantastic, you're probably not that diversified. So when we sit and we help you select which portfolio you're going to invest in, it's really, we've assessed how much capacity for risk you can take, what your tolerance for risk is, and what level of stock versus bonds will help you achieve all of your financial goals. But in any case, we will implement with a broadly diversified global low-cost strategy. And we believe in it. We've only done this for 20 plus years now. I think most of you on the call who have been to an event before or are currently working with us already believe in it. But at the end of the day, it's stick-to-itiveness, right? This isn't one of those things where your foundation should be shook if the market goes down 5% in February, right? We do not abandon a financial plan and an investment strategy because of something like that. If you look at this chart of all these terrible things that have happened going back to 1926, there is one consistent trend here. The market goes up over time, and that it is almost impossible to predict what the market will do after a certain event happens. Now, stick-to-itiveness, staying in your seat, not reacting to these moments, Those are the people who over time are financially successful. The people who bail on the stock market at the worst possible moment will never get confirmation that it's safe to go back in. And at the end of the day, they will never financially recover from something like that. We saw this a lot in the U.S. after 2008. For us, the financial plan and all of the work that we do leading up to that, it informs what will happen if a market event occurs. What will happen to you? Will you be able to survive it? It is one of those things that we test for, and I'm proud to say that most folks that we talk to, that we work with, that's the thing that keeps them in their seats, the belief and the understanding that they can survive these terrible things over time, right? So don't panic. The other thing that we do here as we move towards the end is, once you get into retirement, you need to start living off of your investments. And that becomes the real challenge, right? How do I draw down on my portfolio over time? One of the things that we'll do is show you all of your estimated required minimum distributions from your IRAs over time. So really over the next 20 or 30 years, we'll show you exactly how to withdraw from your portfolios in a tax efficient way, which accounts to tap first, which to tap second. And more importantly than that, we'll show you what percentage you're taking out. There's this 4% rule that's been around for quite a while now, meaning that if you're taking out on average 4% or less of your portfolio, which should survive a 30-year retirement, that's probably under a little bit of stress at these in today's day and age. But it is important to know by percentage how much you're withdrawing from your portfolio on an annual basis. And we'll show you that, and we'll show you if it's sustainable. We'll help you select how to withdraw from your accounts, right? And we'll show you what types of assets like stocks or bonds to hold in each of these accounts to increase the overall tax efficiency of your portfolio. Because at the end of the day, taxes matter. That's another thing we overlook, but I didn't want to focus too much on taxes within this presentation. But it is something that you should really focus on as well. Being as tax efficient as possible with your investments, your withdrawal strategies, it can save a lot of money over time. And one of the things that, Vanguard did this study, which is on the screen here, that was, well, what should an investor or a client of a financial planning firm, what should they expect versus doing it themselves or just working with a typical stockbroker who doesn't actually do all of these additional services? And when Vanguard did the measurement, it was essentially stated that, at least 50 basis points or 0.5% can be added to the long-term rate of return by doing a financial plan. Correctly allocating their portfolio can add another 0.25% of return over time. Picking the right investments, right? We looked at how bad professional money managers who think they can beat the stock market are over time can be. Making sure that you rebalance on an annual basis, but rebalance in a logical way that uses all of your accounts and is tax conscientious is very important. And tax management, right? I talked about that just a second ago. Making sure you own bonds in qualified accounts, stocks in certain different types of accounts. In Roths, you want to own certain types of assets. And then you want to have appropriate withdrawal strategies, because managing what an individual pays in taxes on an annual basis, and certainly over the course of their lifetime, is extremely important. So when you wrap all of this up, it can add over 3% to your returns over time, right? We tend to think about, well, the S&P did 5%. Forget about the S&P. There's a lot of other things that can add value to your bottom line, and Vanguard did a great study on this. So we get started with really the idea of risk, and we have a pretty cool technology here called Riskalyze. We certainly work to measure your capacity for risk, and this measures your tolerance for it, right? How much do I want to take a portfolio risk? This gauges how you answer certain questions based on certain market events, and it's a pretty interesting tool to help gauge that number. It's something that takes maybe 5 to 10 minutes, and there's a lot of interesting information that can be garnered from this particular software. Additionally, we build personalized client websites for folks, where I said we aggregate in all of your financial data. So your 401k plan from your employer, your banks, your credit cards, your insurance policies, anything like that, we can pull in and help you with your budget and help to consolidate your financial life, right? I think, the old way of having 10 different accounts at 10 different places and spreading them out on the dining room table, those days are over. We have a solution for you. It's a great way to work interactively with us. And that really leads into the next thing. When we're doing financial planning for folks, we have what we call our decision center. And this is where we test all of these different strategies for you. What if I worked one more year? What if I retired a year earlier? What if I spent $10,000 more in retirement? What if I didn't travel? What if I worked part-time or cut my my travel expenses? What if I sold my house, downsized, bought a boat? All of these things are done on the fly. You can see its immediate impact of, well, over the life of my plan, I'm more probable to survive a 30 or 40-year retirement. This increases my lifetime bottom line by X or by Y. This is an incredibly fun, interactive tool that I encourage you all to ask about and take a look at. It's a lot of fun. It really shows the impact of any decision that you might be making, and really allows us to have better insight into what your goals for the near term and, more importantly, for the long term are. So those are essentially the 5 big risks and how we combat them. Quite honestly, we want to make sure that we're keeping an eye on all of these things. And I know our technology, our investment solution, can certainly help to improve your day-to-day management of your financial lives in any way that we can help. I'm certainly more than willing to do that, as is our entire Apella team. So I will let you all return to your afternoons. I do appreciate your time. If there is anything else we can do for you, don't hesitate to reach out. I appreciate you spending some time this afternoon with me, and have a great day, and I will talk to you all very soon.